Stocks looking pretty good. Nasdaq's a little bit lower here today. We've got a man from the Nasdaq joining us here in studio, Kevin Davitt, head of index options content. Kevin, always good to see you, sir.
Good to see you too, Oliver. Thanks for having me.
Sure thing. It's your guys' anniversary, so how could we not? What, a week away from now, the 40th for the Nasdaq?
The 40th anniversary on the 31st of January, worth celebrating. I think we are really hitting our stride, moving into middle age, something I'd know something about and you wouldn't.
All seems pretty close.
Yeah, so throughout that history, just some high-level facts, 500 constituent names throughout that time, so obviously it cycles annually. 6 of the names that were part of that original core in 1985 remain part of it now, names like Apple, Costco, Micron, Intel, names that people know and are increasingly important. If you think about it in terms of market cap, average market cap when the index was originally constituted was right around 580 million, and now we're talking about 280 billion on average. So talk about some growth.
Hey, hold on a second though. Shout out to PACCAR, which is the only non-tech name that's been in there since the original. Because it's Costco,
right.
Intel, Micron, Apple, Kelly, Tincor, and PACCAR.
Well, Costco.
Oh, true. Okay, Costco.
Yeah.
All right. Well, I guess they sell some big electronics. All right. Yeah, you got me on that one. All right. So right now, we're basically, the most concentrated markets have ever been. S&P in the Nifty 50 days had some periods of concentration like this. This is pretty new for the Nasdaq, but is that just kind of the way we expect it to work over time? Is that just kind of how capital markets should work?
It's a good question. It's gotten a lot of ink over the past couple of years where you have seen a handful of names that kind of drive both those major large cap indices leading the markets. It's not so, I think it's something that can be concerning, but when you talk about historical periods and compare it to now, the amount of revenue and profits that these companies are generating is very, very different than when you look back historically. And so I don't want to have, put my foot in my mouth. There are certainly risks. I think those are risks that can be managed at the index level, and I think the options are arguably an ideal way to potentially express that. And I think it is going on across markets and in particular in the NDX.
Well, it's working. It's also like, what are the options? What are you going to do? Kick out companies for getting huge and generating tons of profits?
Right.
It just kind of seems like this is nature taking its course. What about for investors when you think about it versus the broader market? Do you view it as a sort of beta play, or is that oversimplifying? Is this just a better stock picking strategy that the Nasdaq has used to get the right companies?
So I'm not here giving advice.
Sure.
But when I think about, I got a kid that's 10. And when I think about the future and investing and what's likely to drive and the makeup, if you think at the sector level, what's likely to drive, I don't believe that things are necessarily imbalanced on the tech side. It has been the case for the better part of the past 2 decades, and I believe that will only continue into the future. Could I be wrong? Absolutely. It's also worth noting 40 years ago that NASDAQ put together a financials index as well, because as you kind of alluded to, Nasdaq-100 is ex-financials. By and large, since the crisis, they have been a drag on other indices. And so when I think about my son investing and saving for the future, increasingly you're seeing portfolios that look like the Nasdaq-100, and I wouldn't consider that just beta.
Yeah, good argument. And it also seems that it fits some of those very traditional investment themes of buy what you know, buy what you see around you, especially when you talk about younger folks too, because all this stuff is around us everywhere. Look at Netflix on earnings, for example. Think about the people that doubted Reed Hastings along the way.
Yeah, there were plenty of opportunities for that across those names. That is how markets work, kind of to your bigger point, and they likely will continue to. You bring up an interesting point with earnings. Netflix yesterday, how the options price that moved a little bit more than the market expected. We have a big number, so if you think in terms of market capitalization, something around the lines of 45% of the Nasdaq-100 will report next week. I think we're seeing considerable positioning in advance of that.
Tell me what you're seeing real quick on the options stuff relative to those earnings.
So we're seeing what is typical. There has been, as you have noted numerous times, considerable growth in the short-dated options. And I think when you're talking about earnings and talking about really being able to target your exposure over specific timeframes, that's likely to continue. And next week, I think, will be a perfect example of that. So you're talking about the likes of Apple reporting, Microsoft, Meta. You had the list on before I came on.
Oh, yeah, the giants.
And so if you have interest in that individual name, it's one way to play it. And arguably another way to play it would be at the index level, or something you've also talked about, the dispersion. One point there is that the options market is arguably pricing expected dispersion considerably higher than it has going into previous earnings cycles. What I mean by that is the implied volatility at the single stock name level is higher than it typically is at this point relative to the index.
Okay, we just had a chart up. I think it was looking at the money calls. Last point real fast, 'cause we got to get into our panel, but I think this is what a lot of people like to see. Tell me, this is compared to a year ago, right? So the vol pricing's, blue line is last year, so vol pricing's down a little bit?
That's correct. So this is actually reflecting bid-ask spreads as a percentage of strike. And so you want to see those continue to come in. We're doing market quality.
Better bang for your buck, right?
Correct. And as your listeners know, being able to narrow that bid-ask spread to trade near midpoint can be very, very valuable over long time frames. And many compare this view to the Q's options, which have some unique attributes. Where you could get early assignment or that potential pin risk on expiry days.
Yeah.
And so we like to see this, and we think it's been a catalyst for more and more volume growth.
Makes sense.
Does indeed.
Good stuff. Always a unique perspective, Kevin. Thank you.
Thanks for having me.
Yeah, good stuff.